Hey, good afternoon. My name is Rick Leimbach, founder and CFO advisor at Startup Portal. So today we're taking you through our fourth episode of our equity crowdfunding series. And I thought I'd just get started showing you some examples of the data we have behind the scenes with regards to equity crowdfunding and the information that we can share with you as you're looking and analyzing equity crowdfunding. So assuming you're someone that is looking to raise capital, and one of the alternatives out there, outside of going to the bank, private equity, is equity crowdfunding, which we've talked about for a few weeks now. Certainly, you can follow us on YouTube. With equity crowdfunding, there is a certain model for each business compared to each funding portal. And there are about 60 portals. But here, as an example, if we say, hey, we want to be a software company, we can look at the different type of equity raises by the software companies to see what type of funds the companies have raised. As you can see here, there's a significant amount of capital that has been raised in equity crowdfunding. A couple of these companies have, one company almost hit 10 million, as you can see, from just 3,500 investors. Caveat that there may be additional funds behind it from a previous raise, but still substantial for a company. So equity crowdfunding allows bigger companies, as you can see here, to raise capital. In addition, equity crowdfunding also allows smaller companies. So let's say we're in the restaurant industry. We can pick out a restaurant industry and maybe go to a portal by the name of Honeycomb. And Honeycomb will allow people to raise capital from $20,000 to $50,000 range, and certainly that in between, which may become very important as we look into the state of the economy, where companies just need that additional financing to help them step up and make it through. So as you can see here, there's a bunch of companies that have raised different amounts of monies with their businesses, and allows them to really get in position to essentially take the next steps or manage financing. Some of this is refinancing debt. So lots of different scenarios, to the extent that we're a company that we say, hey, we're really looking to do what's called a debt offering. So there's all kinds of different debt offerings. This we use to help people understand what is out there and what fits their business model compared to the environment out there. Now, with that said, I'm going to switch over to our deck. We just want to talk about equity crowdfunding from the CFO perspective, especially when you're going down the path. What's it mean, and what can we do with it? And we'll show you some examples as we go. My name again is Rick Leimbach, CFO advisor here, and also an advisor and owner of Carrollton Partners, which is outsourced CFO and consulting. Certainly my gray hair and my 30 years of experience hopefully can help tell the story and educate you. Startup Portal is really designed to be that affordable cloud-based solution for you to have that fractional outsourced CFO, whether it's CFO, accounting, bookkeeping, advisory, business writing, et cetera. So we're here to help be that fractional piece as you're looking to grow your business. Now, traditionally, financing is I go to the bank, go to private equity, have a kind of a one-on-one conversation. Before COVID, people would go on road shows, or they personally have done it, where you get in a car for about 3 weeks, and as the CFO, I'm there with the CEO and COO, basically asking private equity funds for capital. With equity crowdfunding, essentially your roadshow is on a portal, and you're talking to the crowd of investors, friends, and families, as well as people that are interested in your category and maybe have invested in other companies in that portal. So with that said, it's kind of that modern financing, and even to date, there's a sense that equity crowdfunding may even move to help the crowd as well. There are different types of equity crowdfunding. The common stock is your share ownership. Safe agreement is like if you essentially provide funds to a company, and they're going to hold it until some transaction occurs, whether they raise money or they get sold by another company. But you'll have sort of a cap on the valuation that you would have for the ownership of the company. So they just put a cap on it, and above the cap, if the company goes, the value goes like crazy, you benefit from it. Debt agreements, there's straight up debt. There's what's called convertible debt, where you take debt on the books until some transaction similar to SAFE occurs. Essentially you have a debt agreement on the books. And then rev share, where it's a form of debt, but you're paying back based on the revenue percentage of your of the funds have been advanced to you. So very, very good in the hospitality restaurant industry, where they're generating revenue right away and they're paying you back right away. Now, I mentioned there's 60 plus portals. With regulation crowdfunding, you can raise up to $5 million on essentially CF, and then the next level, Reg A, you can raise up to $75 million. Each of these funds and portals have their own business model. Bigger ones have Start Engine, WeFunder, Mainvest, have more deals than smaller ones, but everybody has their sort of business model, like Equity Door has real estate. So really, when you're thinking about your business model, putting that together and how you're going to fund, you want to think about which portal would fit me, if equity crowdfunding even fits you, and am I going to need additional cash flow down the road? So really keep that in perspective as you go. Now, a couple examples here. Unity Wellness Company, they're on WeFunder. They've raised $485,000, just 79 investors. That's 6,000 plus per investor, which is a lot higher than normal. I say the average normal is probably 1,000 or less. With WeFunder, though, they typically ask you to bring in a strong financial backing, maybe someone putting in 50 or 100K to really, honestly, get the party started, but get things moving. Now, most crowdfunding raises could be 90 to 120 days. These folks have basically put themselves out there for 300 plus days to raise capital. So they're going to get this $1 million over the next X period of time. Essentially, that the $1 million over the next year, likely based on the fact that they're 485,000 in already, they're going to raise that. The $9 million valuation cap is essentially, as I mentioned earlier, basically what the maximum amount your investment will be worth day one. Now, as the company grows and proves its value, the company may then jump to a $20 million valuation. That additional $11 million value basically stays with you, as you're just capped out at $9 million. So you share in the upside. And that's the idea of having the convertible debt and the cap on it. It allows the company to be a little more flexible with their fundraising without locking down common stock price and as you get into the equity world, I want to say locking yourself down. So it gives you a little more flexibility. And these guys basically have beverages, protein bars to reduce stress. So that's their sort of their avenue, their angle. Now, Scaeva Technologies, they're with Start Engine. They've raised $93,000, 22 investors. Again, a little higher, 4,000 per investor. They only have 7 days left. So their window is closing pretty quickly. Not likely that they're going to get to the $1 million they want it, but I imagine they'll get it, with the push, can get over the $100,000. Now, with that said, the valuation here, and these guys are in the audio, audio content creative market, which likely could bring a higher valuation, and hopefully for them, this crowdfunding of 100K, hopefully it helps them to get to the next level. Now, the interesting part about crowdfunding is there may be opportunity for them to step back and say, you know what, our raise wasn't strong enough. Let's pull back and maybe come back with a stronger message, a new valuation or something that, or a strong, someone strong to position them to really get the ball started. So lots of things going on here in the next 7 days for this company. Now, the next example, Lambs, they're on an open deal portal. They've raised $441,000, average about $1,000 per investor, which makes sense. Now, they've taken the long road as well. They've got 266 days left. More than likely, they'll reach their $1 million well before the 266. For them, then the health apparel business. They've got a SAFE agreement and a $30 million valuation. So it's a pretty high valuation. The numbers behind it hopefully will show that certainly their product brands are worth it. Now, last one that we're going to talk about is Iconic Motorbikes. And they've raised $410,000 from 59 investors through Start Engine, almost $7,000 per investor, which is pretty good. Their goal is $1 million, and they have about 51 days left to hit that goal. Their valuation on this is $20 million, and it's straight up common stock offering. And they buy and sell iconic motorcycles. Now, probably went through it very quickly, and we do have three other episodes previously that you can find on YouTube. But really analyzing whether equity crowdfunding is for you. Do you have that product or service that really is crowd centric? If you're a brewery, if you have a product that the crowd will like and want to be part of, does the capital cover what you need in the future? Sometimes the near, sometimes the long, just depends. If you need another financing, fine, or you can raise enough capital to get you to that second financing. Do you enjoy having shareholders, stakeholders, loan holders as they're part of your team and your family now? And keeping the business structure simple. If you're in real estate, typically every entity has an LLC. If you're in a corporation, there may be sub corporations behind that. Is your entity simple? You don't want to get too convoluted, especially if you're going to need additional capital down the road. If it's simple, it's straightforward, it may be for you. And I'm leaving that maybe in the middle to really do your analysis of, does it fit for you? Hey, this doesn't fit for me. There are a couple things to consider is, do you need significant private equity? As an example, let's say you need a $50,000, you could do crowdfunding for a prototype, but knowing you're going to need 10 million down the road for marketing, product build, etc. Is equity crowdfunding right for you? I would do the research to say, hey, does private equity fit a little better? And maybe try to find private equity companies that specialize in a product or prototype and can help get you there, or funding programs that allow for grants in your state technology corridor or groups, etc. So really think about that. Is your funding needs uncertain? If you're going to equity crowdfund for 100K for the next 90 days, it may not be the best idea if you're not sure what you're going to need after that. Just for the fact that it takes 90 days to crowdfund. So really the time involved with that is significant. And to start over just for 100K may seem like, hey, it solves my problem, but it may be creating additional problems for you. The value, if you already have a valuation of a company, let's say you've already done a private equity raise and you have a certain valuation, and to basically do crowdfunding, you need to have a higher valuation. I'd really think twice about that as well, because if it's not sufficient to get you to the full plan, let's say, or at least significantly down the road, it could impact you in a negative way, in that your next round of capital may be at a lower valuation. So thinking through that. And then the only aspect that is, just for clarity, is you do have to report for 3 years after you do a crowd raise through the SEC on an annual form A-R, which is an annual report. Certainly it's putting your financials together and telling your story once a year. Is it significant? No, it's something you have to plan for, etc. So with that, really the question is, does equity crowdfunding fit you? Maybe, maybe not. So really do the analysis to find out and help yourself in planning and make sure you're making the right decisions. So I thank you for listening to our equity crowdfunding series. Certainly follow us on YouTube, Instagram, send us an email. Without a doubt, we're here to answer questions, provide information, and hopefully help you through your journey. Our aspect is that we're fractional financial CFOs, controllers, accountants. But more importantly is we will provide you the information to have the best and strongest decision for yourself as you venture out there or need refinancing, etc. So as I showed you in the data at the beginning, we can help you, and just follow along, especially if it's not ready for today. Join along so we can share our information with you. So once again, thank you, and look for us this summer with additional series of financial projections or financial accounting or a show or two to allow us to share information that we have that will benefit everyone as you're raising capital or looking for financial advice. Take care.